And there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered.
Today we have Raoul discussing the looming banking crisis that is boiling over and believes that we're now months away from a catastrophic event. The collapse we're seeing of many countries' fiat money systems indicates that the situation is extremely dire. The recent inflation numbers are also a signal of these systems' instability and is surging as we speak. Raoul emphasizes that the repercussions are tangible, impacting people's ability to afford housing, food, and energy. And soon we'll see an inevitable run on the banks. He points out that not only is the economy spiraling out of control, but an abundance of money printing and misallocated investments is contributing to capital disappearance. This pattern, involving trillions of dollars, has fed into an elusive financial void controlled by major accounting firms. With this accelerated wave of bank failures, Chase, Citigroup, and Bank of America are just three institutions that are facing this crisis. Powell believes hundreds of banks are insolvent and sustained by convenient accounting methods, which will be put on display as we start seeing more banking collapses in the months ahead. Let's get right into the latest interview with Raoul as he gives his market prediction for the last part of 2023 and how crypto will play a massive role in financial and stock markets worldwide. Don't forget to share your thoughts and comments down below and leave a like if you enjoy the content we do here. Let's get right into the video.
Markets are just sloppy. There's nothing really going on. There's no new money around. Everybody's in the Hamptons. All of that kind of stuff is going on. So you have to be patient in summer markets. And usually once you start getting through August, September, things start kicking off. The things that I'm looking to kick off are, as rates have been decoupling from the market. So I actually got stopped out of my bond trade. Finally, I got out of that bloody pain. It was a terrible position. Because bonds basically decouple from the business cycle this time around. It's nothing to do with inflation. It's actually to do with liquidity because of how the Fed are, the Treasury are issuing so many new bonds to pay the interest on the bonds because rates are so high. They're doing it in the bills market. That's draining the reverse repo, but it's still flowing through into the rest of the bond market, and yields have been rising. That whole process has started pushing the banks lower again. So I'm keeping my eye on that. But what it's telling me is we're getting closer to more cowbell. That point where the Fed have to go, oh, and that happened last time, if you remember, in December 2018, when suddenly the repo market broke and the Fed was like, we're stopping QT, and we're not going to hike anymore. And then they started cutting 6 to 9 months later. We're in that phase, I think. Let's see what Jackson Hole has. Powell still thinks he's Volcker and it's a ridiculously different environment, but that's what they want to believe right now. So my guess is that the payback for this is, I think they're going to undershoot inflation. So I'm strongly of the opinion inflation is well below 2%, maybe even as low as 0 by the end of the year. And that's been my call for a while now. And I think core inflation goes to 0 by summer to this time next year. So I think we've got all of the inflation domino to play out from the GMI business cycle dominoes. We have, I think, a rise of unemployment will come over this period. I don't think it's going to be huge because there's some complications in the labor market as people are leaving the labor market, etc. And I think, rents are coming down, all of that stuff. So what we're likely to see is the Fed going, sorry, we've undershot, which gives them the cover to cut rates, which they need to do because they cannot pay the interest on the debt at these levels ongoing. They've got about 13 trillion of debt to roll over plus new issuance. They need to get rates lower and they need to then monetize the interest payments. That's part of the everything code thesis, those of you who've been following along at home. So the everything code thesis suggests that Q4 is going to be when this start of action starts happening, and we don't, maybe QT stops, maybe we get a rate cut, maybe we don't, but we start flagging it, and then we start to see, I think, another leg of the economic slowdown. I think we're actually bouncing out the forward-looking indicators of ISM, all of this stuff I've been talking about in pro macro on Real Vision. That's where you get all the juicy stuff. So you guys watching this, most of you aren't pro macro subscribers, so you don't get all of the research that I put together, but we do a lot of stuff. And that's suggesting that we are going to seeing a sharp economic rebound. That was forecasted by liquidity and the GMI Financial Conditions Index. It is starting to slow down a bit because of these yields and the dollar stabilizing. And so that suggests that Q1 next year, so we might get a pickup in growth at the end of this year. Now, that won't come into GDP. GDP's lagged. Everything kind of lags in this. So GDP should be weaker in Q4. I know that the Cleveland Fed have this ridiculous 5.9% number. That'll go away. But we should see GDP low, but the forward-looking indicators, stuff like ISM, start to pick up. And then we might get another slowdown within Q1. But I think at that point, the market is more focused on the cowbell.
With an air of urgency, he also highlights the mounting concerns encircling the colossal $6 trillion debt maturation slated by year-end. Amid this fiscal tightrope walk, Powell discusses the economic indicators we're seeing, as well as the debt dynamics and the pivotal role of central banks in shaping the market in the last part of the year.
And then we're into the full election year, and the full election year is cowbell central, because then you've got stimulus to try and bribe the voters, rate cuts to bribe the voters, the use of the balance sheet to try and not get the Treasury to end up with ridiculous debts on their trying to issue ridiculous amounts of bonds and the market not being able to do it, and crowding out the private sector. All to play for Q4 when it gets interesting. Everyone needs to get back from holiday, and then we can see from there. Real yields are a real issue. They're too damn high. I mean, they're super high right now, and that is going to continue to erode inflation and economic growth going forward. So my view is that countries high in debt cannot run long-term positive real yields, and that the trend rate of real yield is probably negative 1%. So I think in the next cycle, we go back to trend rate of real yields. And I think that is the only way you can get around an aging population with massive debts. And we see that all over the world. Raoul, John Kitchener, I'd love to hear your thoughts on Citi. I don't know, but I've used these very long-term charts of banks since the European crisis in 2012. And I've called it the cliff of death. And one by one, many of these banks have gone over the cliff of death, and that they've needed to be bailed out. Whether it was the Italian banks, the Spanish banks, the German banks, the Swiss banks, and there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered. I mean, it just fell like a stone and then has been trading sideways ever since. And that cliff, or that plateau, feels like it just wants to jump off that. So I don't really know what, well, we know why. Rates are too high, the yield curve's inverted, the banking system's not fully functioning, et cetera, et cetera. So there's a lot of reasons why not to like banks, but cyclically, at this point, they should start to improve once the yield curve improves. Banks aren't always negative, and as soon as we start to get the yield curve steepening and rates coming, then banks tend to do okay. So that's usually fine. What are your top 3 trades? John Floyd. John, my trades, I'm not a trader, really. I think you've probably figured that out by now. My time horizons are very long. So for me, it is number 1 crypto over my time horizon. Let's just use this business cycle, not even going further out. Let's say over the next, into end of 2025, I think crypto is the best performing asset in the world. I think technology stocks are number 2. And number 3, tricky. Tricky could be something commodity related. Copper. Let's go with copper.
Raoul Pal uncovers how changes in cryptocurrencies can send ripples effects through our wallets. Imagine a world where borrowing money becomes more expensive. Those cool credit card deals and car leases might not be as sweet. But it's not just about numbers. It's about fairness and how many things we can buy. Among the market noise, Bitcoin emerges as a rebel in the money world, shaking up old traditions. Powell points out that the everything code is like saying money is this invisible thread that's connecting it all together. With big banks being the guardians of balance, he says they're working behind the scenes to keep things steady, preventing financial chaos, but he believes the inevitable is coming. What do you think about the latest interview with Raoul Pal, and how do you think his prediction for Bitcoin, crypto, and the financial market plays out in the last part of 2023? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.